Welcome back, traders. Here back at the Benzinga studio, and we got Hubert Senters on the line to talk about some of his trading strategies. Hubert, how you doing today?
I'm doing good. How are you?
Good. Dennis, you want to give a shout out to Hubert?
Hey Hubert, how's it going?
What's going on, Dennis?
Not too much.
Just before we delve into the interview here, could you just give us a little bit of your education and market background?
Education and market background. When I grew up, I thought I wanted to be a veterinarian. I put in a ton of hours with large animals and small animals trying to figure out how to do that, and figured out before I went off and wasted another 5 years in college that I actually didn't want to do that. And so I met a guy that was trading, and he kind of took me underneath his wing, and I did like a 2-year apprentice with this guy for every day for the past 2 years. When I originally got started up, he would just show me everything that he was doing. So I've been trading since then, probably 18 to 20 years since then, and still trade to this day. So I mean that's a short version of how I got started, I guess.
What kind of stuff was he showing you? Like, what was he trading? Was he trading stocks or options or futures, or what was he like showing you there?
I mean, back then, I dropped out of college early, and I started up a fleet maintenance on wheels, which is basically a quick lube on wheels. And this guy owned a chain of transmission shops, and one day at lunch, because what I would do is I would take vehicles to his shop, he would fix them, and then I would just charge an extra fee on top of that, right? So it was a little bit of middleman markup is all I was doing. And one day he goes, "Hey, I'm having lunch back here. Come on back. We'll settle up on these invoices that you owe me money on, and you can watch me trade." And I'm like, "What are you trading?" I walk around the corner, and he's got these two 21-inch. You remember the old monitors, the big cathode ray tubes, that were like heaters, right? And he had 400 equities on there. He had the bid, the last, the net, the volume, and the high and the low on the day. And he was just sitting there, just a good old fashioned tape reader, looking at 400 equities and going, "Okay, well, I'm going to buy this one, I'm going to buy that one, and I'm going to buy that one." No charts whatsoever, just a quote screen. And I was like, "That's amazing." So I sat down there and watched him make like $32,000 in 18 minutes, and I'm like, "Oh my God, I'm in the wrong business. I'm in the wrong business." Yeah.
And when was this?
Oh, that was probably 18. That's probably 18 years ago.
Okay.
Right when the internet, basically, and the day trading was just starting.
Yep.
Like 95, 96. That's right when it was starting to come off the floor and starting to go onto the computer. So you're right in the sweet spot there.
Exactly. When it was all back in fractions, when you had to have a poster up on your machine going, "Okay, a 7/16 bigger than 5/8." No, it's not.
I remember when I first started up, I was the same thing. I had to learn the teeny and the eighth and the 3 teenies and the quarter. I had them all written down, trying to figure them all out because we were in teenies. I was doing the exact same thing as a little young buck there. Remember that, Joel? You were trying to teach me the teenies and the eighths.
Yeah.
Memories.
Basic math. So let's get a little bit into your trading style. Are you more of a day trader or a swing trader? Just to follow up on that, your preferred method of technical analysis. Are you a candlestick, bar chart, or other indicators you use?
I think I'm a little bit of everything. I mean, I know everybody has a particular style that you kind of gravitate towards. The guy that originally taught me how to trade, his name was David, and he was just a ballsy trader. I don't know if I can say that on radio, but I mean, He just had cojones the size of church bells, right? He would take everything that we had. He took everything that we had, and he would place it in like one trade, and he'd have me calling like, "Hey, can we get more than 8,000 shares of Cisco?" And I'm like, "No, we can't get more. It's 4-1. That's all we can have." And we would just go either long or short. We would scan for things at the close that were either taking out the high or taking out the low, and we'd just place the bet at the end of the day going, "Okay, I guess we'll see how it's working in the morning," right? And we'd walk in the morning, we'd have big 6-figure swings, and I mean, it didn't seem to bother him, and it didn't bother me because it's his money. So I was like, "Okay, whatever." So when I originally started out, I was more of like a swing trader for 2 to 3 days to 2 to 3 weeks.
Okay.
And then I switched over to being a super hyper scalper, just because we were doing a lot of that intraday. As of right now, I would say I'm probably 70% a swing trader, 30% a day trader. I make more money swing trading than I do day trading, but I really like the day trading because I think it keeps you sharp. As far as the technical analysis, I'm just a good old-fashioned tape reader, and I would say my technical analysis that I kind of fall back on more than anything would be candlestick charts, and I use a lot of Ichimoku. I'm a huge proponent of Japanese candlesticks and Ichimoku technical analysis, just because it makes everything easy.
Can you discuss that Ichimoku technical analysis? Because that's not one that most of our listeners would be familiar with.
Okay, all right. So it kind of sounds weird. It's probably especially with my thick Kentucky accent. So the way you pronounce it is Ichimoku. I know it sounds like someone sneezed, but that's not really what you're doing. A better name for us Americans, since we're all uneducated on this side of the pond, I guess, is cloud charts. All right. The cool thing about this technical analysis strategy is it gives you past, present, and future. Okay, so it's going to give you where the past price action was, which all technical analysis does that. The future of where it thinks it's going to go, and it also gives you the present. So it gives you past, present, and future. And what it does is it's there's not a whole lot of text out there on it, and the texts that are out there are not that great. So you're going to have to scour the internet and get 5 or 6 different books. It's the name for it is called, the Japanese translation is at a glance. So you'll know exactly what's going on really quickly at a glance. And I'll pull up a chart really quickly here. What stock you guys want to take a look at?
Let's see something that has some price data on it. Let's go with Facebook.
Okay, Facebook, FB. All right, so Facebook right now, and I know you guys may or may not have the Ichimoku on your chart, but what I've got is I've got Facebook in a massive uptrend. It is above the cloud, and all the cloud is just a blue ribbon. Okay, so there's some default settings in Ichimoku, and the default settings are 9, 26, 52, 26. So the first moving average, and it's not really a moving average, it's a midpoint average, is a 9 midpoint average. So that's going to be your turning line. That's going to be your short-term moving average. Then you're going to have a midterm moving average, which is going to be a 26. But the thing that you're really looking for is this ribbon of support that is holding up Facebook, which is about 45. Okay, so as long as Facebook holds 45, you should be good for higher price action. Now, if the price action was below the blue envelope, then it would be considered a bearish setup. So if Facebook trades below, it's going to have to trade. I'm putting on my chart here real quick. Facebook is probably going to have to trade below for 3 days. It's going to have to trade below 43.53, and then at that point, then it would be in a new downtrend and would probably go lower.
So right now, your system's saying Facebook is still a decent buy.
Yeah. So right now on Ichimoku cloud charting, it's telling you like, all right, Facebook's in a valid uptrend. You should be a buyer all the way down until about 43. If it breaks 43, you should get out and start going short.
Now, what's your stops? Obviously you're coming in this, and let's say you come in and you bought Facebook today because the system was looking at it. How far away do you set your stops? To say, okay, well, the trade didn't work out, I'm going to cut my losses here. Now, what's your parameters there?
There's a couple different ways you can do it. On Ichimoku, you can just use the turning line or the standard line. So in other words, if we were to short it today, we should be buying it. But if we shorted it today, we would short it at below 45, and our stop would be about 50. So you'd use about a 5-point stop loss on that. So you just have to back into about a 2% risk on your percentage trade there.
Okay, so those are pretty wide parameters there. So those are for your
swing trading.
For your swing trades. You'd like to break down technical analysis into simple, actionable steps. I mean, is this what you're talking about with the Ichimoku, or is there other ways that you break it down into simple steps?
Ichimoku is probably one of the best ways to teach people technical analysis, because when you first look at it, it really, really looks complicated. The only other thing I would probably add to the chart would probably be a parabolic SAR, because that's going to give that'll give you a tighter stop. So if we were looking at Facebook again, let's say if we were going to go short on Facebook, as an example, if it goes below 45, then the stop we would today we could use 49, 48, so it's a little tighter stop loss. The good thing about Ichimoku is it only takes about an hour, maybe 2 hours to learn it, and then after you know the 6 setups, it's super simple. It just looks really complicated because there's so much going on in the chart, but you just have to break it down so that everybody kind of understands it really quick.
What stocks are you concentrating on? Like, is there certain stocks this works better with, or are you looking at like bigger cap stocks, or what kind of stocks are you using at, and what kind of stocks are you trading?
So you want to make sure that anything that you're trading in Ichimoku, it's got to have good volume. So you want to anything higher than $15 is usually good. Or if it's below $15, as long as it's taking good volume. There's been some backtest studying on Ichimoku where if you take both sides of the signal, the long short and the short long, on I think 80% of the stocks on the S&P 500, it's back tested to return you a 33% return. Now, if you filter that out, if you filter out the counter trend signals and you only take the 3 candlestick confirmation with the lagging line, it should increase almost double your return on your investment into the low 70s. So it broad spectrum. It works on a lot of different stuff. The stuff that I'm in right now currently with Ichimoku, it would be short Tesla.
Yep. When did it tip you off on the Tesla? Like when?
All right. So one. Let me count back. 1, 2, 3, 4, 5, 6, 7, 8. 8 days ago, there was an official short on Ichimoku 8 days ago on Tesla, and at that point, Tesla was trading at 137.78. Okay. So, and today it's trading at 126.09. So not too bad. Now you could have got in earlier, but this is the slowest signal that you can take. And it's a confirmation signal as okay, heads up, Tesla's in a new downtrend. You want to focus on shorts only now because it's now below 137.78.
Okay, and obviously you're still in this trade right now here too. So obviously,
Yep. I've liquidated half of it, so I've covered half of it for some profit, and then I moved the stop to break even, and now I'm just waiting to see if it's going to drop below 120.
Yeah, because obviously this has had a huge move here where we've got down to 119.22 from 137. So some of these positions you're holding on for multiple percents here, like this pretty big move.
Yeah. I mean, usually what I do is my style of trading is a little weird. I take losses on lots and lots of trades, but they're usually really small losses. Yeah. So there's nothing abnormal about any of my trades. A lot of them are only about 35% profitable. And if I'm doing really, really well, I'll have a win-loss ratio of about 42%. But on some of my future stuff, where I'm trading gold or bonds, I'm risking very small amounts of money. So in other words, I've got trades where I'll risk $156 to make $1,000, or if I'm trading gold, I'll risk $600 to make $6,000. So I really only have to be right one time or 2 times out of 10, and I'm still making decent cash.
It's amazing when we talk to professional traders how much different the thinking is from a retail trader, because professional traders are always looking, at their risk, and they're always managing their risk very well, where a retail trader will come in and obviously they're looking more for the return, what can I make on this? And then when the risk starts happening, they start getting down the trade, they're kind of like the deer caught in the headlights, and they don't know what to do. So it's all about, it sounds like you have very good risk management techniques here as well.
I think it's just because I'm a chicken.
But that's, you know what? I'm a chicken too, and I've been in the business for 15 years, and I think by being a chicken, it keeps me in the business. So I think being a chicken in trading is good. I think that's a good thing.
I think it is too. I think the difference between an amateur and a professional is the amateur always thinks about the reward first, and the professional always thinks about the risk first. Yeah. And I think we come off as being a little scared or a little chicken, like, whoa, what's the risk on that trade? Where the mom and pop investor is like, well, how much can you make? Like, who cares? How much can I lose? So it definitely is. Risk is the main thing. So yeah.
Yeah, that's a good, excellent point here. And then I think you've kind of summed this up in the previous discussion that we've had here. But you said that you learn the right things about the market is important, and avoid the wrong things. Could you just put a couple things out there? I mean, we've already talked about risk reward and pie in the sky and things like that. Are there any other tips you might have out there for novice investors or traders?
All right, so this is probably going to sting a little bit, mom and pop or retail investors. So let's bust a few myths here. So number one, if you're losing money, it's probably not the market's fault. It's probably yours, right? And I know it's
I've
kind of
heard
hard.
that one.
It's kind of hard to hear at first because you're like, no, it's those daggone market makers. They're running
It's the high
stops on me.
frequency traders. It's
Yeah.
all their fault.
The funny thing is, like, I trade.
Robots.
Yeah, it's all those robots. I trade more futures than I trade anything, and I hear people like, "Oh, the market makers got me," and I'm like, "Dude, there are no market makers in futures. What are you talking about?" And they're like, "No, they ran my stops." I'm like, "Hold on, wait a minute. Let's get this. How many contracts do you have?" "Oh, I have 5 contracts." Okay, so everybody in Wall Street decided we were going to move $10 billion in market capital to get your 5 lots.
They did.
And then we're going to go higher. Is that the deal? That's what we're doing?
Of course they are.
Yeah. So, I mean, the main thing is your main competition is yourself usually, because as soon as you throw a trade on, I don't know about either one of you, but I've never got smarter once I'm in a trade. I almost always get dumber once. As soon as I click, I'm like, oh, God, get out, hurry, get out. Hurry, take the profit,
You've added emotion to it. I mean, that's the whole thing. It's easy. And that's why there's such a big difference between paper trading and real trading, because all of a sudden fear, emotion, everything else comes in. You'll see some people that'll practice strategies and back test strategies and do all this stuff for so long, and then they go live with that, and it's just a mess because all of a sudden emotion comes into it all. Maybe that's sometimes why the robots on Wall Street do good too, because they don't have emotion to worry about.
It may be, and we get a lot of those questions from people like, "Hey, I've been paper trading for like 6 months and I'm doing really good." I'm like, "Well, how's that working for your mortgage? Will the bank take that paper money from you?" And they're like, "No, I don't understand. Like when I go live, why is it different?" I'm like, "Oh, it's the pucker factor." They're like, "Well, I don't understand." I'm like, "Well, you're going to tighten up a little bit when real money is involved here."
The pucker.
I was like, and things are just going to tighten up on you, and you're just going to trade worse. And they're like, "No, I shouldn't." I'm like, "Yeah, but you will." I think that's one of the things. Like a lot of people think. Paper trading is good from one standpoint because you can learn how to hit the buttons, right? You know what a stop is and a target and trail and all that stuff. But then after that, there's a gap analysis where, all right, this is what I'm doing in my paper fantasy trading, and then this is what I'm doing in my real account. So there's a gap, and you should try to narrow that gap as much as you can over time. Another thing I think that's bad for people is I've never really met very many professional traders that trade off of the news and make money long term. In other words, like, well, the FOMC came out and the numbers were so and so, and they'll be like, "Why is the market going up?" Like, your job's not to figure out why it's going up. Your job is to say, "Hey, it's going up. Are you long?"
Yep.
Or, "Okay, the numbers are bad. Why are we going up?" A lot of the economic news release stuff just does not make sense to retail investors. Heads up to us professionals, it doesn't make a lot of sense either. What we do is we have just learned, like, oh, those numbers don't really matter. How's the market reacting to those numbers is really the most important thing.
Joel, he's preaching your book there, right there. With if we don't, and that's the whole thing we always talk about, and it's exactly right. We agree with you, Hubert, that basically, you can look at these numbers and you can say, oh, well, that doesn't make any sense. The market's going down on this. I'm going to buy it. Well, no, the market always makes sense. Pricing action, is correct. The one thing, so that's the one thing. You don't have to be an economist to trade stocks. You don't have to be a fundamental analyst to trade stocks. You just have to be able to recognize that, hey, they like this report and they're buying it. Or, hey, they don't like it and they're selling it. So that's a really good tip there, Hubert.
Yeah, one thing we try and talk about, because we concentrate a lot on the pre-market activity and the wild gyrations that go on, and a lot of times we'll tell the traders, this stock is up $7, $8, $9. If there's an opportunity for you to exit your long trade, and this is a target that you've been waiting for, then take advantage of the opportunity to make, to put your action, to put your plan in place. Not necessarily, shorting a stock that's up $10 because you think it's overdone. Using the pre-market trading, and that's what we try and talk about on our show and with our traders is having a game plan, letting the markets come to your game plan, knowing where your entry, knowing where your out is, and it seems like you employ those same tactics. Just a few other things here before we wrap up the interview. And I know that your partner works on the Sunday night strategies. I mean, I know I like to follow the spoos on Sunday nights, and there's just huge moves in that. And a lot of times, economic news out of Europe or things that are going on over the weekend. Are you up there trading on Sunday night, or are you just using that kind of as a barometer for your Monday trading?
I actually do a lot of overnight trading. So I'll wait till the markets close up and I'll trade gold and bonds after they reopen up on Globex and stuff. So I do quite a bit of trading on Sunday evening around 6 o'clock. I want to see where gold's at. I want to see where bonds are at, and put on a few positions there. There's some really good trades that you can do pre-market, and there's some really good stuff that you can do, post-market stuff. So I'm a huge fan of that stuff. And the good thing about you can't do a whole lot of stock stuff because it's not open, but you can do a lot of future stuff. And a lot of the futures markets nowadays, are open 23 hours a day or 23 hours and 15 minutes. So, I mean, there's definitely opportunities there, and I'm always doing stuff like that.
Okay, one last question I want to ask, too, is if you can do it, what does Ichimoku say about Twitter right now?
Well, it's TWTR. So Ichimoku, oddly enough, it's going to need more data because we've only had so many days.
Oh, gotcha.
But I will tell you one strategy that I use a lot in for IPO stuff. So, and I worked wonderful on Facebook.
Okay.
So if you can pull up a chart of Facebook, so let's go back to the original IPO of Facebook. I'll condense my chart about the same thing here really quickly. Okay. All right. So, and this strategy works on a lot of IPOs. So when Facebook opened up, we had a reading of a low of about $37.99, right? And we went to a high of $45.04.
Okay.
So the best way, in my opinion, to do IPOs is just play on people's fear and greed. Not that I hate Facebook or not that I love it. I'm just like, it's a trade, right? So when you first do, like, you can short Twitter right now. You're going to have to pay a 30% premium because it's on the hard to borrow list. So if you hate Twitter and you think it's going lower,
is that what it is right now? It's 30% right now to borrow that.
Yeah. I think it. Well, I know it was on the first and the second day of the IPO. It's probably came down a little bit since then, but it was definitely 30% to borrow it. Yeah. So bracket the first day. So like on Facebook, it was $45.04, $37.99. The next day, if it's below the low, then it's probably going to continue to go lower. If it's above the high, it's probably going to go higher. So now you can't really short things unless you have a really good brokerage firm that can get the stuff hard to borrow, and they'll charge you an arm and a leg for it, right? Yeah. So the best thing to do is mark the high at 45.05 or 45, and then just divide that by 2. So in other words, you're going to have a blue light special on the stock. So $45 divided by 2 is going to be $22.50, right? So the best thing to do on Facebook would have been to buy it at $22.50, place a stop, and then let it bounce. So let's take the same strategy with Twitter, TWTR. So if we take the same strategy with Twitter had a high of about 50.10, and it had a low of 43.99. The next day, it closed below 43.99. So it's probably going to do a 50% retracement now.
Oh, cow!
I know, right?
Some people are probably
right?
like, "Oh, good. What are you telling me? I better go sell her now."
Well, I mean, the good thing is if it gets down to $25, I guess if you own it at 50, which is a lot of what a lot of retail traders will say, well, if you love it at 50, you will love it even better at 25, right? Which I hate. I hate when people say that. I'm like, no, that's the wrong way. But I mean, if it goes to 25, it's going to be a really good buy. And if it never gets to 25, and if you're already long in the 40s, you don't really have anything to worry about it in the first place.
Right, I was talking about that. We've been following up because I kind of like when stocks, when they just have a few days of trading, because there's the points. And what I was looking at was you had that 50.10 high, 50.09 high, and then you had that scoop down to 39.40. Basically a 10-point drop. And when this thing got back up to $45, which was also the opening, it opened at $45.10 and then it closed at $44.90 on the first day of trading. I mean, that was a major level, and it snuck up there for a couple days. And I even put it out. I said, if Twitter holds 45, I'll reluctantly get bullish here, and it didn't, and now it's fallen off the cliff. Now, to me, I'm not going to throw the baby out out with the bathwater until we take out this 3940 low. But using those parameters, that you talked about, I didn't use like the half trick, the 50 high off the 25. Definitely would have worked well on Facebook though. But wow, Hubert, I'd say I hope Sangalucci's not listening because I said he was our favorite interview. But you definitely throw some humor in there and have a good perspective on the markets. Thank you very much.